Hello learners, welcome to today's lesson. We're going to look at an introduction to the income of taxation of incomes of persons. Incomes of persons. This is a new topic. So we will divide this into two. One, we look at the law governing taxation of income. Then we shall look at definition of a person. And then we look at taxable incomes. So we divide our lesson into three segments. We start with the law governing taxation of income. Now, as we know, the Tax Act is what defines this. So we will be, in the whole of this topic, which shall be the partnerships, the sole proprietorships, the companies, the trusts, the circles, and such, we're going to be looking at the Income Tax Act, Chapter or Cap 470 of the laws of Kenya. So anytime we say ITA, ITA will be the Income Tax Act, Chapter 470 of the laws of Kenya. So we'll be reading through the Act and seeing the provisions of the Act regarding the taxation of income of persons. That means that anything beyond the Act will not be for us because we cannot go beyond the law that has been provided. So having said that, let's look at the definition of a person. Now from law, there are two types of persons, which is the same thing that has been borrowed in tax. That when you talk of a person, the income of a person will be saying that any income accruing to what we shall call a person shall be subjected to the Income Tax Act. So we will be reading section 3, subsection 1 of the Income Tax Act. But briefly, where a person is concerned, we're going to have two. One, this is going to be the natural person. And two, this is a legal person. Natural person is flesh and blood, people who've been born. Then legal person is as a result of legal creations. So be looking at income accruing to individuals. For example, individuals could be employed, so income from employment. Individuals could own property. Individuals could have investments and many other sources. Then for the legal person, this is a legal creation. So be dealing with companies, trusts, sporting associations, specialized institutions like banks, insurance companies, circles, and any other legal creation. Now the difference is this, that according to the Income Tax Act, there are different laws or different tax laws that are going to apply to the natural person and the legal person. For example, for a natural person, we will tax all your income, and then after that, we will aggregate it together, and after that, we shall deduct what we shall call reliefs. The reliefs will not, we will see this later, the reliefs will not be available for the legal person. For the legal persons, we shall tax them using a tax rate that is proportional. That was covered in the introduction to tax, where we said that there are three main types or classifications of tax. Said it can either be classified according to administration procedures, or according to the rates, or according to the units that they are based on. So those three. So when you are dealing with the legal person, it will be under where we said rates, there is going to be a proportional tax. Right. Now we get back to what we are looking at. So we've defined a person. We've said that a person is either a natural person or a legal person. We're not going to go to the Income Tax Act and we will get an extract of that act, because we've said it's the one that is guiding the taxation of incomes of persons. And we will read. So what I'm holding is an extract of the Income Tax Act, the revised edition. So we'll read Section 3, subsection 1 of the Income Tax Act. So it reads, subject to and in accordance with this Act, a tax to be known as income tax shall be charged for each year of income upon all the income of a person, whether resident or non-resident, which accrued in or was derived from Kenya. So we are going to read through that again and explain exactly what it means. So we'll just highlight the keywords. So I go through it again. Section 3, subsection 1 of the Income Tax Act of the Laws of Kenya, chapter 470, reads, subject to and in accordance with this Act. So remember, everything we do must be guided by the Act. A tax to be known as income tax shall be charged for each year of income. So income tax is, you go back to classification of tax. There was classification of tax based on the tax base. Tax base was the item with reference to which tax is being levied. So if the item is, we are levying tax on income, income tax. We are levying tax on output, for example, value added tax. We are levying tax on what you've imported into the country, customs duty or customs tax. So that was the base. So you're saying the base for income tax is the income that is received by a person, whether that person is an individual or whether that person is incorporated, shall be charged for each year of income. That gives the frequency or the regularity of the payment of tax, that it is according to an year of income. So we will look at what is year of income. Year of income. We said we are levying tax on a person, on the income that is accruing to a person for an year of income. So we want to see what is an year of income with regard to, 1, a natural person, 2, a legal person. So to a natural person, individuals, you and I, our year of income runs from 1st January to 31st December every year. So this means that the year of income is the same as the calendar year. Why is this important? Because when it comes to tax returns, you need to make your returns for the year of income. So if the year of income is 2018, 2019, 2020, whichever, it will be 1st of January, beginning of that year, to 31st of December, beginning of that year. Like you're going to see later, you're going to now list or inform the Revenue Authority on all the incomes that you made within these 12 months. So long as that income was derived from Kenya. Remember, you're reading Section 3, subsection 1 of the ITA. So that's the calendar year. That's why we're supposed to make our returns, tax returns, for each year of income by 30th of June the following year. This is a key date because normally KRA will run adverts reminding people, please file your returns by 30th of June of whatever year. That means by this 30th of June, so you have 1st of January to 30th of June, for those 6 months, you're supposed to declare your previous 12 months income. we're going to see the specified sources of income so that we can see which incomes you're going to declare. So that is year of income regarding a natural person. So when it's applied to a legal person, this year of income has two issues. It can either be one, corresponding to the financial year, to the entity's financial year. This will be upon application, upon a successful application to the commissioner. And the commissioner will normally grant you. Or it could be 1st January, whatever year, to 31st December, the same year. Now, like, it's going to be covered much later, that when a company is paying its taxes, it pays through a system called installment return. That means you're supposed to pay current year's tax in the current year. But for the purposes of this topic, this is what an year of income when applied to a legal person, a company, for example. We're using a company because it's the most common form of a legal person. So it's when you need to change it from 1st of January to 31st of December, then you're saying you need to apply to the commissioner, and the commissioner needs to put it in writing that he has allowed you to have an year of income that is corresponding to your company's financial year, so that as you declare your financial results, you're able to pay your taxes. That is the whole point behind the idea. So we get back to what we are covering. So we've said the law governing taxation of income in Kenya is Income Tax Act, Chapter 470. We are defining a person, and when you're defining a person, we've come across a key term, year of income. So we get back to Section 3, subsection 1. So subject to and in according to with this act, a tax known as income tax shall be charged for each year of income. We've said what that means. Upon all the income of a person. So the key term will be all the income of a person, whether resident or non-resident. So we'll come to the issue of residence later. So all the income of a person means income or specified income. And this is specified in Income Tax Act, and this is Section 3, subsection 1. So we continue with the Act. So it reads, subsection 2 reads, subject to this Act, income upon which tax is chargeable under this Act is income in respect of 1. Gains or profits from a business for whatever period of time carried on. 2. Employment or services rendered. 3. A right granted to another person for use or occupation of property. That was A. B. Dividends or interest. C. Roman 1. A pension, charge or annuity. And Roman 2. Any withdrawal from or payment out of a registered pension fund or a registered provident fund or a registered individual retirement fund. And Roman 3. Any withdrawals from registered home ownership savings plan. Then E, an amount deemed to be the income of a person under this Act or by rules under this Act. All right. So that is what now the Act tells us. Remember, we are looking at we must operate within the confines of the Act. So that is what is defined as all the income of a person. So we've read Section 3, subsection 2, not 1. You delete that. This is subsection 2 of the Income Tax Act, Chapter 470. So we're going to summarize all those specified sources of income. So the first one is employment income. Employment income, including past employment. Past employment is pension and provident funds. Then there is business income. You realize that the Act says business income for whatever period of time carried on. So you're not looking at, you've been in business for the past 10 years, you've been in business for the past 1 year. No, we're going to look at what was the motive of whatever transaction you were engaging in. So business income. Then there is farming income. Then there is investment income. This comprises of dividends and interests. Then we have income from property. This again comprises of rent and royalties. Then the final part has EF. The final part has deemed income. So these are the specified sources of income. So according to the Act, we shall read that part again. According to the Act, if a person, whether a natural person or a legal person, receives income from in Kenya, income that is derived in Kenya, whether that person is resident or non-resident, so long as they're deriving income from Kenya, from any of these sources, employment or past employment, business income, farming income, investment income, income from property, rent and royalties, or deemed income, any of this is what they're supposed to declare. So we continue with the section 3, subsection 1. So subject to, and in according to this Act, a tax to be known as income tax shall be charged for each year of income upon all the income of a person, whether resident or non-resident, which is accrued in or was derived from Kenya. So we need to define what Kenya is. So Kenya for tax purposes includes 1, Kenyan airspace. So let's includes 1, Kenyan airspace. 2, Kenyan territorial waters. And 3, the land enclosed within Kenyan boundaries. That is what Kenya is. Kenyan airspace, that's why if you fly over Kenya, you pay tax. Territorial waters is the portion of, for example, Indian Ocean, that is Kenya, that is considered as Kenya. The portion of Lake Victoria, that is considered as Kenya, that is our territorial waters. So like, if you're a fisherman and you're fishing within our territory, then you're deriving income from Kenya, and therefore we need to subject it to taxation. Then land enclosed within the Kenyan boundaries with our neighbors, the way the Kenyan map is. So all that. So if you're doing business, if you're employed within this, what you're defining as Kenya, and or you were employed in Kenya, but for some reason you retired, then business income, you're doing business in our space, territorial waters, or within the land, or you're farming, commercial farming, within what you've described as Kenya. You've invested, so you're earning dividends from a company in Kenya. You have money in some bank in Kenya, or you have developed some property within Kenya and you're collecting rent. So that is what all the income of a person means. There is another term, which is resident or non-resident. Resident, non-resident. Now, the residential status of a person determines the rate of tax that is going to be used. We shall see that later. And the scope of the income that shall be taxed. We shall also see that later. But briefly, residential status, when applied to, we've said we have two types of persons. So when applied to one, a natural person, means that this person was in Kenya for at least 6 months, 183 days. So you have a permanent home in Kenya and you are in Kenya. That's the first one. You have a permanent home in Kenya and you are present. And you are present in Kenya for that year of income under consideration. Or you don't have a permanent home in Kenya, but no permanent home, but you were in Kenya, for more than 183 days in the year under consideration, year of income, or 122 days for 3-year average. That means if you take these 122 days and you divide by 30, you'll get 4 months. So it means ordinarily you are available in Kenya for at least 4 months consolidated. January, we've said year of income for an individual is January to December. So January to December consolidated, the number of days you're usually in Kenya is more than 4 months. So we consider you as one of us, a Kenyan. Therefore, you are a resident person for tax purposes.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.